Hello there. Welcome to the Open right here on BNN Bloomberg. US and Canadian stocks closing at yet another record high yesterday. And this morning's inflation numbers south of the border apparently reassuring investors that price increases are under control in the USA. Let's get to the other big stories we're bringing you from the BNN Bloomberg newsroom. U.S. consumer prices in December were 2.7% higher than a year earlier. This report marks the first complete look at inflation trends in months. Cooling labor market, of course, remains a top concern for Americans. Price gains were led by increases in the cost of shelter, food, and energy. The report caps off a year in which inflation has gradually eased, but remains uneven across the economy. JP Morgan's fourth quarter adjusted revenue met estimates. That's despite investment banking fees unexpectedly falling. The biggest U.S. bank generated more than $2 billion U.S. from the business in the last 3 months of 2025, and that was down 5% year over year. The Prime Minister, Mr. Carney, is meeting with coastal First Nations in British Columbia today to discuss major projects. The president of the coastal First Nations has said there's no support among the group for a new pipeline or a suspension of the oil tanker moratorium off the northern coast of the province. This comes ahead of the Prime Minister's departure for China, where he aims to boost engagement on trade, energy, agriculture, and international security. Looks like U.S. stocks are going to open narrowly in fresh record territory this morning. And let's check out the TSX and how it traded yesterday. It closed at a new record high, just like the S&P 500. Let's have a look at oil here. And oil, you can see, has been rallying over the past few sessions. Now, of course, there's always multifarious factors, but it may be concern over supply from Iran, even though a lot of that's sanctioned amid ongoing violence and turmoil in that country. And let's have a look at gold. Gold blasting to new record highs yesterday, and looks like it is hitting new records today. And finally, let's have a look at the Canadian dollar. The Canadian dollar holding its own against the U.S. currency. We're getting earnings from the giant U.S. banks. JP Morgan's profits rose in the fourth quarter, but investment banking fees fell, missing the firm's own guidance. Let's get more from Lauren Steinberg, president of Lauren Steinberg Wealth Management. Lauren, great to see you right here in the studio as well. Anything jump out for you with these JP Morgan numbers?
Certainly, I think the investment banking numbers are overblown, Andy. This is an incredibly choppy business, and quarter to quarter, it's hard to draw conclusions. JP Morgan remains number one in that business. I think what does stand out in a serious way is that market volatility led to huge increase in trading revenues. And that augurs well for 2026, where we expect to see continued volatility. Also, incredible strength in the asset management business as well. And JP Morgan is forecasting improvement with net interest margins going forward in 2026. So listen, you're not going to get the same boost in earnings that you had in 2025, but we're still bullish on the stock and on our shareholder.
Let's put up so the stock doing not much in the pre-market. Maybe you can put up a 10-year chart. It's been a thing of beauty to own for years.
Absolutely.
Is this almost a stock you can just own and forget about?
So I have to say, Jamie Dimon has managed to avoid every bucket of manure, if one could say that, that other banks have gotten themselves into. Clearly, their internal controls are astoundingly strong for this size of bank. Mm-hmm. And, you know, there will always be a question mark, you know, the day that Jamie Dimon decides to resign, mm-hmm. The new person will be under pressure, but it's certainly been that way, and it's a core holding in our firm.
What risk do you see right now for equity investors with markets at record highs?
Well, certainly one of the risks is any interference with the Fed. And it just brings back to mind in 1980s, the term bond vigilantes was coined by Ed Yardeni, where the bond market got worried that inflation was going to get out of control and drove up interest rates. And we're already seeing, signs of investors skittish on that way. So that's one risk. Another risk certainly is if the U.S. government gets involved in capping interest rates and getting involved in other industries, that would be a serious issue for investors. So, these are some of them. And also geopolitical, which I usually don't worry about, but which is a bigger issue today, I would say.
Although the credit card thing, it seems that it would be tricky for U.S. President Donald Trump. He'd need Congress to back him. Maybe he'll get the best of both worlds. He won't really have to antagonize the banks, but he can claim, well, I tried.
Absolutely. And of course, the risk of capping credit card interest rates as high as they are, and they're astoundingly high, is that it then pushes borrowers who are desperate to go to places they probably shouldn't go and spend even more money.
Broadly, how do you feel about U.S. stocks, Lauren? Are you seeing opportunities there, or is the market a bit inflated?
Some sectors are a bit inflated, but we're seeing actually plenty of opportunities. The economy is resilient. One area we see opportunities, Andy, is actually in a couple of technology companies which have AI exposure. The first one is Adobe, which for some reason is trading at 14 times earnings with double-digit revenue, earnings, and free cash flow growth. Huge profit margins. They bought back 4% of their shares last year. And the fears that, AI may hurt their business, it's the opposite. AI should help their business. So these shares are massively undervalued. And the other technology company is Cisco, which for years has been more or less a flatlining revenue company. But Cisco has returned to growth. They're huge in security. They bought Splunk for $27 billion, which is giving them huge AI exposure. And this company has returned to growth. And again, it remains an incredibly cheap stock, a consistent dividend payer and buyback of shares.
It's interesting. Those are two tech companies that have been around for a long time.
Absolutely. And at the top of their game, number one in their fields. They remain at the top after so many years.
Are you worried that, I think I've heard it said tech, value stock in tech can be a contradiction in terms.
It can be a value trap, but in this case, both these companies are growing. So this is not these are not flatlining businesses. These are huge margin, big free cash flow, and they've both been great capital allocators.
And aggressive buybacks by Adobe. What is your feeling? Are we in an AI bubble when it comes to some other stocks? Is there going to be pain?
I certainly think there's going to be some pain for some companies because there's so many hundreds of billions of dollars being spent on data centers and other things. Some of this money undoubtedly will not be spent well. The companies themselves, it's even hard to project what are their revenues and what kind of returns are they going to get for some of these investments. So the majors like, Alphabet and Amazon, Microsoft and Meta, et cetera, they're the survivors. They'll be the top. But some of the other companies that have raised billions of dollars with no revenues, that's where we have big question marks.
Even though, let's put up Google, aka Alphabet, maybe a 10-year chart. The thing languished actually earlier in the year last year, then came roaring back.
Fears of AI.
Yeah. People thought search would get hollowed out. I must say, I don't use AI that much, but I do find this propensity of it pretending to know when it doesn't. I wish it would more often say, no, I don't know, sorry.
And it's not 100% accurate, and it can be dangerous. And we're in the earliest days of individuals and people even figuring out how to use it, what it means, and what the value is.
I was going to say Alphabet for sure. It's an investor darling. But if, say, we get a company like OpenAI gets in over its skis with the massive debt and spending, would that not cast a shadow over the other internet stocks? AI stocks?
It may or may not, because the other option, what I think will happen is they'll end up being fewer competitors.
Yeah.
And the competitors that are left will be the ones that will be the winners in all of this. And listen, every major bank in Canada and elsewhere, they're all in net layoff. They're rolling AI throughout their institutions in order to make people more efficient and have fewer people doing more. So AI is real. Really, the question is the amount of money that's being spent going to generate an acceptable return?
Lauren, thank you very much indeed.
Great to be here, Andy. Thank you.
Lauren Steinberg, president of Lauren Steinberg Wealth Management. Coming up, Canadian transportation authorities logged more than 100 reports of disruptive air passengers last year, and one airline saw 60% of the incidents. That's ahead. There's a growing backlash against the criminal investigation of Fed Chair Jerome Powell. Some key Republicans are pushing back. ABC's Lionel Moyes has more.
Today, President Trump heads to Michigan, focusing on the economy, with polls showing Americans worried about jobs and affordability. Trump will tour a factory that produces Ford trucks. The president also teasing a deal with Microsoft to help lower utility bills, which have been rising across the country in part because of energy-hungry artificial intelligence data centers. Trump posting the big technology companies who build them must pay their own way. Trump is also reviving a pledge to cap credit card interest rates at 10% for 1 year.
I want a cap on credit card interest rates because, some of them are 28, almost 30%. And that people don't know they're paying 30%.
Critics warn capping credit card rates could have devastating risks.
The real victims would probably be the millions of Americans who no longer be able to borrow money. Some people are bad credit risks, and these companies simply won't lend to any of them.
Bank and credit card stocks falling on the news Monday, but there could be bipartisan support for Trump's proposal.
The White House is beginning finally to feel the heat. That American families are in worse financial shape than they were when Donald Trump was sworn in a year ago.
Senator Elizabeth Warren says she spoke with Trump. Warren saying Congress can pass legislation to cap credit card rates if he will actually fight for it. Consumers also grappling with inflation. The government is set to release a new inflation report today as the president pushes the Federal Reserve to lower interest rates. Fed Chairman Jerome Powell claims that push for lower rates is behind the Justice Department's new criminal investigation looking into Powell's testimony about expensive renovations at Fed headquarters.
Senator Tom Tillis is vowing to oppose the confirmation of any nominee to the Federal Reserve Board until legal matters concerning Powell are resolved. Treasury Secretary Scott Bessent has been quoted saying the investigation into Powell causes a mess that's bad for the markets. Lionel Moyes, ABC News, New York.
Up next, we are going to look at that report that Canadian Airlines logged more than 100 incidents of disruptive passengers in 2025. We're talking about assaults on flight attendants, smoking on board, and even indecent exposure. Canadian transportation regulators logged 114 reports of disruptive air passengers in 2025. The incidents also include passengers accused of inappropriate touching, sneaking onto flights, vaping cannabis, and a wide range of, quote, intoxicated and unruly behavior. Okay, Scott Hurst joins us now. He's our colleague at CTV News. Scott, I don't know. What are people thinking of?
Andrew, let me start with one example here that I pulled from this list. A flight from Toronto to Vancouver in 2025 where the pilot had to execute a missed approach, divert the landing, telling air traffic control that it was because a passenger refused to sit down. Now, that is disruptive, of course, and then delayed that flight and everyone on board. But there are many more examples that can be considered much more serious and severe. And you ran through a list of some of them, including uttering threats, instigating fights, vaping, and as you mentioned, even indecent exposure, just to name a few. Now, these incidents last year caused numerous delays, forcing flights to be diverted or turned back to the gate. And in many cases, the offending passengers were arrested or escorted off the plane by police, and some, according to the data, even added to no-fly lists. Now, airlines do have a zero tolerance for any form of any form of abuse directed at employees or other passengers. And cabin crew do go through extensive training to help de-escalate situations. But unfortunately, these situations do arise. Now, we should point out, compared to the number of flying passengers, the millions of flights taken every year, this is a very small example. But union reps for flight attendants, who are often the first line of contact, do tell CTV News that disruptive passenger incidents do often go underreported, depending ultimately on the severity of the incidents and how quickly they might escalate.
That's interesting. I guess if a flight has to turn back, and then the plane's next flight is going to be disrupted, the whole system is so complicated. Were there any trends when it comes to particular airlines or particular cities?
Yeah, we could talk regionally about trends where we saw the largest number of reported incidents actually come from Calgary, followed by Toronto. And as you see the list right there, the top 5 is rounded out by Vancouver, Montreal, and Edmonton. And of the 114 disruptive passenger reports in 2025, that is actually down from 176 in 2024 and 197 in 2023. And there was actually well over 230 in 2022, but also Transport Canada does point out that year there were well over 1,000 incidents of passengers refusing to comply with mask mandates, which were in place through much of that year. And for more information on the unruly behavior and the number of incidents, you can feel free to go to our website, ndctvnews.ca, where there's a lot more on this report.
Thank you very much, Scott. Scott Hurst, our colleague at CTV News. The Prime Minister heading to China today. It marks the first visit by a Prime Minister to that nation in almost a decade. Let's get more on what we should look out for from BNN Bloomberg's Lindsay Biscaya. Lindsay.
Yeah, and Andy, really a lot of people seeing this as a test for Prime Minister Mark Carney, but also like a sign of the times. We're seeing him kind of jet set around the world over the next couple of weeks, going to all these different countries, many where Canada has had kind of iffy relationships for a couple of years now, China included in that. This is the first time a Prime Minister is going to China on a trip since 2017. Ultimately, Mark Carney looking to diversify trade. And when it comes to China, oil is expected to be top of the agenda in terms of what Mark Carney might want to be talking about, especially given what's happened in Venezuela recently. We know that China is one of the top importers of Venezuelan oil. Maybe they're looking for an alternative at this point, albeit Canadian oil is a little bit pricier. But it might be something that Mark Carney wants to potentially look at when it comes to diversifying trade, particularly with oil. But a lot of economists saying this might just be kind of a warm-up meeting, right? And this is the second time that Prime Minister Mark Carney and Xi Jinping have spoken face-to-face. They met at a summit back in October or back in the fall. And so a lot of people are saying, don't get too excited about this in terms of talks or what we could expect to come from this meeting, because it's been a frosty relationship for some time, and this might just be kind of like a heating up in terms of getting that relationship back on track.
I see the Chinese are advising Canada to get out from under U.S. foreign policy to assert our independence. So there could be implications here for the Canadian-U.S. relationship.
Well, that's what's so interesting. And yeah, you see China kind of looking into that as well, right? Flexing their muscles a little bit. Yes, there is a fine line that Mark Carney needs to walk between China and the U.S. Of course, China and the U.S. have their whole own relationship going on. But it's really interesting. I was speaking with some economists last week, and they were pointing out when CUSMA was renegotiated last time, there was actually a section in CUSMA that said if any of the three parties sign a free trade agreement with a non-market economy, they need to notify the other two parties, so Mexico or the U.S. or Mexico and Canada, for example, before signing any agreement. Obviously, there's probably no free trade agreement expected to be signed between Canada and China this week, but it really just goes to show how important any kind of trade with China is to the U.S. when it comes to Mexico and Canada. And we saw that when it comes to tariffs on the EVs, right? The U.S. put very heavy tariffs on Chinese EVs and then pressured Canada and Mexico to do the same. So a very fine line to walk here between the two. And we're, of course, also seeing two Canadian MPs coming back from Taiwan. They say they're quitting a sponsored trip that they were on in Taiwan just to, quote, avoid confusion. So a very, very fine line that Mark Carney and Canada is going to have to be walking over the next couple of weeks.
Thanks very much indeed, Lindsay. Let's have a look at U.S. futures as we count down to the opening bell. And remember that U.S. stocks did end at a record high yesterday. So far, 2026 working out pretty well for equity investors after a very lucrative 2025. So far this year, the TSX is up almost 4%. Not a bad move in just less than 2 weeks of 2026. We got the S&P 500 up around 2%. Let's have a look at JP Morgan, the gigantic U.S. bank, and of course, one that's produced huge returns for investors over the years. As we touched on with Lawrence Steinberg earlier, there was a drop in investment banking fees, and there was an overall decline in profit of 7%. However, revenue did rise, higher interest income and fees. The profit on the surface missing expectations, $4.63 US a share in the fourth quarter. Estimates were for about $4.85. A full year profit, though, for this bank, $57 billion. That was down from a record high of $58.5 billion last year. Full year revenue topping $182 billion. Let's have a quick look now at oil, because oil has been showing signs of strength this morning. Geopolitical risks said to be the factor here. The Brent price, the global oil contract, topping $65 US a barrel. The US escalating pressure on Iran. And we did see an attack near a vital terminal for Kazakh crude. Obviously, the Kazakh oil industry very tied in with Russia. There's been drone attacks, bad weather, and maintenance at this Caspian Pipeline Consortium terminal. And that has been raising fears for supply. So we've seen options markets betting on the risk of a surge in prices. Oil, though, still down more than 20% in the past year. And let's have a look at gold. I'm going to check the old spot price of gold. If you want to go down and bring some of your bracelets and your tiaras and see what the local gold merchant will offer. So you can see the February future once again trading in record territory. Gold having this possibly ominous run. Investors apparently interested in a haven. And once again, we have got spot gold in record territory right now. The latest I've seen is $4,620. Let's have a look at the U.S. bond yield. Maybe we can have a look at a 1 week chart for that, because you would expect that if people are concerned about the integrity of the Fed, you'd get selling in U.S. government bonds. And briefly, we did see yields rising yesterday. Thanks, control room. There is a look at the U.S. bond yield. You can see it did spike earlier yesterday and then dropped, and now it's down. We're going to be exploring that later on the show. The apparent calm in the markets over U.S. President Donald Trump's latest assault on the Fed. We're going to be right back with those opening bells. Opening bell ceremonies on Bay Street and Wall Street. At the NASDAQ, it's the Bancorp Incorporated doing the honors. At the NYSE, it's Pinnacle Financial Partners ringing the bell. And in Toronto, it's AGF Investments celebrating the launch of AGF's ETF series for legacy funds. It's time for the first 15. Let's have a look at the North American benchmarks as we get going on this Tuesday morning. Yeah, the TSX and the S&P 500 in record territory. TSX pushing further into all-time highs, and the S&P narrowly up. We did get a rise or core inflation for the latest month in the States that was slightly below expectations, and that's reassuring investors, or many of them, that inflation pressures are gradually cooling south of the border, and of course that points to potential interest rates. We are awaiting earnings from Cogeco Communications after the close today. There is that stock pretty flat over the past year. They have invested heavily in U.S. operations where they have faced competition, so that's been one cloud over the stock, but the shares holding their own over the past year. Let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities Team. Thanks very much indeed for joining us. The Pentagon investing $1 billion US in L3 Harris's missile unit.
Yes, and that's sending the stock somewhat sharply higher this morning. This is the top performing stock in the S&P 500. Definitely one worth watching today. So the $1 billion investment is in a convertible equity that the company says will turn into full equity once L3 Harris spins out this missile unit, which is planned for something later this year. So this is a big investment. We have seen the U.S. government invest in a handful of other companies over the course of last year, Intel obviously being one of them, some other critical materials companies. But now we have one in a defense company, and this company is planning to spin out an IPO, this missile unit, in the second half of this year. So we see a great big move. We saw a huge move in this stock in the pre-market session. Stock's up a little bit so far in the regular trading session right now. Definitely worth watching over the course of the day because we did see some very large moves when the U.S. government invested in some other companies over the course of the last year.
JP Morgan, we've been talking about the investment banking fees coming in under expectations.
Yeah, JP Morgan, otherwise, except for the investment banking fees, the results this morning largely were in line with what Wall Street was expecting. It was those investment banking fees that were kind of the one big miss within this bank so far this morning. Now, the stock is worth watching today, just partly looking at the reaction to it, but also because this is the kickoff to U.S. earnings season. JP Morgan reports today, but a handful, in fact, a fairly large handful of the U.S. banks follow on that tomorrow, and then we have the true, we're right into the earnings season after that. So tomorrow we have Goldman Sachs, we have Wells Fargo, we have Morgan Stanley, we have Citi, and am I missing any of them? Bank of America, pardon me. All of them reporting on Wednesday. So it's going to be a busy one. JP Morgan kicking off the earnings season this morning with, as you said, those weaker than expected investment banking results.
And Delta Airlines, Delta Air stock under pressure. Investors not thrilled by the profit outlook.
And there's a Canadian connection here. The profit outlook came in this morning, $6.50 per share to $7.50 as an earnings per share outlook for the full year. Investors are not pleased. Now, the CEO, Edward Bastian, gave an interview with Bloomberg this morning, saying that part of the problem and part of the weakness here is that there's a lack of demand for flights, including from Canadian and from Chinese travelers, tourists not going to the U.S. So we have seen that kind of effect, and in this case, we're seeing it on a U.S. airline. Delta is down, moved lower after this outlook this morning, but also a handful of other U.S. airlines had similar kind of peer moves, sympathy moves lower. Definitely worth watching the entire space today, and as we see results and get into the real heart of U.S. earnings season.
Jeff, thank you very much. Maybe we could have a quick look at Air Canada stock this morning. Scott Hurst talking about unruly passenger incidents reported last year, more than 100 in 2025. And as Scott Hurst, our CTV News colleague, pointed out, Calgary topped the list for cities connected to these incidents. Nearly 60% of all the reports in 2025 came from WestJet flights. And of course, it is based in Calgary. It's interesting, flights to and from Calgary made up almost 40% of all reports. However, as Scott pointed out, when you consider the millions of people who fly every year in Canada, just over 100 reports, 114 incidents, it's arguably not that bad. But, oh, goodness, grow up, people. It's incredible that, I guess, who knows? Some people under a lot of stress. Anyway, coming up, the U.S. Releasing its latest inflation numbers this morning. December core inflation came in lower than expected. And we're going to get more after this from a bond market observer who says that perhaps President Trump's latest actions have helped to reinforce the independence of the Fed. We'll be right back. U.S. inflation releasing inflation data for December. Underlying inflation, sure, it was up, the core rate, but less than economists had expected. Our guest says there's nothing really here that will spur more speculation about a rate cut this month. Let's get the latest from Blake Gwynn, head of U.S. rate strategy at RBC Capital Markets. Blake, thank you very much indeed for joining us. Now, just remind us, as far as I know, the market doesn't expect a rate cut from the Fed this month.
No. Markets have actually almost completely priced that out. We're basically less than 10% now. I think we're at around 5% probability this morning, which is about as close as you can get to zero this far out from a meeting. So markets really not expecting anything. We actually changed our call. We'd been expecting a January cut. We pulled that out after last week's NFP print. Really, I think it would have taken some further weakening in that December print from what we saw in November to get to that January cut. Didn't happen, so we pulled that cut out, and I think that's in line with where consensus is at.
Is the current level of interest rates administered by the Fed, is it stimulating the economy or slowing it, or can you generalize?
Yeah, I mean, look, we've been, generally, I would say a bit more on the hawkish side. I would think that the neutral rate, just given kind of what we've seen in the economy over the last few years, I think it's generally coming out of the pandemic been a bit higher than a lot of policymakers and a lot of people would expect. According to Powell, you know what neutral is by its works in a way, right? So you know if you're there by what you're seeing in the economy. And I think a lot of the growth and a lot of the positive results we saw in 23 into 2024, especially after the Fed delivered those rate hikes, I think that would tell you that the rate wasn't quite as restrictive as we'd expected. I think that some of those factors have come off a bit. So what we're probably seeing, I would generally agree with Powell's assessment that we're closer to that range of neutrals, or rather starting to be inside of that range of neutral estimates from the Fed. But I still think we're probably slightly above it if you're looking at kind of how the Fed's looking at things.
I was reading a beginner book about pickleball last night, and the advice was, be very careful before you launch an attack prematurely. So this is a labored way of getting to Trump's latest attack on the Fed. You think it may have had contrary results, and it may, in fact, in some way strengthen the independence of the Fed?
Well, to be fair, look, I'd prefer that these attacks weren't happening at all.
Right.
I think it's much better to let the Fed make policy independently. But we know the administration's been kind of going through these attacks. And I guess the way I'm kind of thinking about it, think about basically a vaccination for a virus, right? You give a low dose and kind of build up that immune system. And I think yesterday was some of the best proof we've had that there is an immune response. We saw senators, particularly Tillis in the banking committee, who could single-handedly really hold up a lot of Trump's Fed chair nominations. And he did say as much, that basically until this Powell thing is resolved, I'm not going to be forwarding any FOMC nominations. You saw the administration very quickly pull back. We got interviews from several administration officials in the morning, including Trump himself, who kind of said, hey, I don't really know what this was about, talk to the DOJ. So they kind of pulled back from it. And also, I think this is the strongest response we've had from Powell. I think before the last 48 hours, you could have reasonably thought that Powell could have had this view that in the long run care of the institution of the Fed, he may have gone quietly or kind of stepped away. I think the odds of that have gone down a lot. I mean, even if you look at some of these kind of prediction markets, the odds of Powell staying on and serving the rest of his board term, which does run through 2026. So we know his chair term will end, but he could stay on as a board member. The odds that he does that have gone up. So I think what this action over the weekend kind of forced was this immune response to kind of show itself. And so, if I'm kind of comparing to how I'm thinking about Fed independence now versus last week, I actually feel a little bit better that moat is going to hold.
And Bill Pulte, one of Trump's advisors, who was thought to be one of Powell's biggest critics, he also said, well, I don't know anything about it.
Yeah, and reporting that's come out does suggest that he may have been pushing a lot of these actions to begin with. So the fact that he pulled away from it, that also tells you something about how, what kind of pushback the administration is actually feeling on these actions. So again, I just think, I would prefer that we weren't testing the fences, but if we are testing the fences, it's nice to know that maybe those fences are a little bit higher and a little bit stronger than we might have thought a week ago.
And you do know, maybe we can put up a 1-week chart for the U.S. 10-year bond yield. You do know that the market seems pretty calm about this thing.
Yeah, we walked in on Monday after those headlines had kind of surfaced with the curves a bit steeper. That's the kind of reaction, you would expect long end yields to kind of move higher on higher inflation, long run inflation expectations, kind of this uncertainty that would come through in term premium. You would expect to see that kind of action. But by midday, that had largely faded. And again, I think it is some of this response that we saw, the strong pushback from markets, the comments from senators. It is probably some of that helped, helped calm markets and kind of take some of that pricing out of the market by midday.
Thank you very much, Blake, as ever. Blake Gwynn, head of U.S. rate strategy at RBC Capital Markets. Okay, yesterday we were joined on market call by Darren Sissons. He is partner and portfolio manager at Campbell, Lee and Ross Investment Management, and he was covering global technology stocks. His top ideas were Amazon.com, Shell, and Visa. Today on the show, it's Gordon Reid, president and CEO of Goodread Investment Counsel, and Gordon is taking your questions on U.S. stocks. Up next, we'll have more on that weakness in investment banking fees in the latest quarter at JP Morgan. We'll be right back. We got this surprise weakness in investment banking revenue in the latest quarter from JP Morgan. And just looking, there's a surprise decline in debt underwriting fees, for example. Let's get more on these results from the biggest U.S. lender. We're joined by Stephen Bigger, Director of Financial Services Research at Argus Research. Stephen, thanks very much indeed. JP Morgan stock in early trading, pretty flat. Anything jump out for you with these numbers?
Well, good morning, Andy. Yeah, like you said, the investment banking results were a bit weaker than expected. There's been this multi-quarter narrative about how constructive the capital markets environment has been. So this could have been some timing. You have to close deals in the quarter in order to book those revenues, and some of that could get extended into 2026. We're still looking for this extended upturn, and the constructive commentary they did mention on the conference call this morning. The backlog is growing. You've got lower interest rates, you've got improving CEO confidence and boardroom confidence. You've got this pent-up backlog after kind of a weak 3-year period. You've got more relaxed regulatory framework, and all that really bodes well for the both the IPO and the M&A activity for banks with large capital markets operations.
JP Morgan, though, rolling up its sleeves for a fight, it seems, over any attempt to cap interest rates on credit cards. The CFO saying we'd have to significantly change our card businesses and that everything is on the table in pushing back.
Well, it sure is. Yeah, I think we'll see a very strong response by the industry here, as well as the industry advocates in this space. It's very difficult to when you kind of mess with this with a bank's ability to price risk and only just kind of this one part of the equation, the interest rate. Bad things tend to happen. Whether it's the removal of credit availability, which is very much a disservice to consumers. You put extra risk in the system from not being able to cover credit losses adequately. We saw this in the financial crisis, where in the case of home lending in that era, where you make loans too easy to get and fuel speculation. You get bubbles and then a collapse in the very asset you're trying to help. So it's important to be careful here, I think, and take some time. And I don't think that is kind of inherent in the president's 10-day implementation period here. It's guardrails are very important, but it can be overregulation can be just as detrimental as under-regulation or poor regulation.
It's interesting, the stock up more than 30% in the past year. According to Bloomberg, though, there are 19 buys among analysts, but 12 holds and 3 sells. So it sounds like Wall Street not convinced that there's going to be big gains in the near term anyway for the shares.
Well, as much as the narrative on profit growth, I think, is intact. If you ask, all or most of those analysts, they would say, look, it's going to likely be a good year for profits for J.P. Morgan. So the question is about valuation. Has that 30% gain we've seen, is that kind of take into account the expectation of continued improvement in 2026? And I would say, this is kind of a unique time for banks, particularly the large and the global banks, where this a bit of a re-rating is going on. Not only do they have this long runway, we think, of improvement in capital markets, and that is a big wild card in terms of revenues and profits for banks. So that extended upturn could lead to valuation improvement. We also have this kind of generational change in regulatory, right? Ever since the financial crisis, it's been nothing but more and greater regulation, more compliance costs, and all this to satisfy regulators. And we think we're in a period now where that is at a minimum going to stay steady and maybe even more likely soften a bit in terms of capital requirements. So that helps free up capital for lending and other uses, for buybacks, for dividends, and so forth. So I think we're going to have, if you think about the banking industry and kind of how it's evolved, and these stocks are not terribly expensive either, kind of 13 to 15 times are the 26 consensus estimates. So I think there is some more room. I don't expect 30% gains out of these large bank stocks, but and they have outperformed the market the last 2 years running. So this will be a third year. That's a little difficult. But again, I think the momentum is behind the profit story, and the re-rating does help those multiples.
I suppose one thing that could inflate their earnings would be a whole pile of initial public offerings and takeovers in the tech space fueled by AI.
Well, definitely. Certainly if you think about M&A and global announced M&A deal value is up 40% in 2025. So again, a lot of pent-up demand there. It's this boardroom confidence, the competitive pressures to cut costs, the more favorable regulatory environment I mentioned. All of that can add to deal demand. And there's been a lot of these mega deals, especially, definitely in vogue now with. You think about scale across technology or the financial sector, industrials. Falling interest rates obviously is helping on the financing front. We've got banks that are willing and able to lend. We've got a market that's willing and able to accept new equity, new debt issuance. We had $95 billion of investment grade debt issuance in the first week of January. So that's the highest level since the pandemic. Credit spreads are around 15-year lows. So that's very good for debt issuance. And so the market is, I think, is waiting for that, and is helpful in terms of making financing available. So all of that is really helping the M&A environment.
The market's expecting some more cuts from the Fed, maybe not this month, but some more interest rate reductions. Generally, when rates are coming down like that, is it a good time to buy bank stocks?
Well, it can be. Rates are, we talk about rates being, banks rather being asset or liability sensitive, whether they kind of benefit from rising rates or benefit from falling rates. But when rates are too high, you might think, oh, that's great for net interest margins. But banks will always make money off the spread of that, right? So if rates go up, they're raising their deposit costs and they're raising their rates on loans. So at this point, really what we've seen for the last year now is that rates were too high, and that was crimping loan demand. So the fact that as rates do come down here, it is helping to restore some of that loan growth. So that just the growth itself is beneficial for banks, number one. Number two, the other dynamic at play generally is with net interest margins, and a steeper yield curve is definitely beneficial. So we've seen the low rates come down. That's what the Fed controls, but the long rates, either the 10 or the 30-year, kind of staying a bit stable. They did come down around mid-year, but relatively stable. So we've got that steeper yield curve, and that's beneficial for margins. So all of this is beneficial right now. at least for the lending business. But absolute falling or rising rates are not necessarily good or bad for banks. It's kind of where you are in the cycle, and again, those margins, how are they rising or expanding or contracting?
Stephen, thank you very much indeed.
Thank you.
Stephen Bigger, Director of Financial Services Research at Argus Research. Coming up, we'll check out some movers on Bay Street and Wall Street. We saw yet more strength in the silver stocks. Let's check in quickly on Toronto stocks. They did rise to a record at the open today. Our market up around 4% or almost 4% so far in 2026, boosted in part by precious metals. First off, though, let's have a quick look at Maple Leaf Foods, the meat giant. You can see that stock up about 3%. Revenue forecast pleasing investors, and also the dividend going up. Baytex Energy had a downgrade to hold at RBC. That's after a huge run-up in the stock after it announced a deal to sell off its U.S. assets. And once again, we're seeing strength in silver stocks. Endeavour Silver, EDR, higher price target raise at B. Riley. First Majestic Silver also climbing. The actual price of silver itself soaring again today, up more than $3 and hitting a new record high north of $88.90 US per ounce. Silver just going ballistic there. Coming up, the TSX has been outperforming the S&P 500 again this year. Can that run continue? Stay tuned. Welcome to the second hour of The Open. Thank you very much for joining us this morning. Let's check out the big stories we're bringing you from our newsroom. U.S. consumer prices in December were up 2.7% year over year. This report marks the first complete look at inflation trends in months. High prices and a cooling labor market remain top concerns for Americans. Price gains in the latest period were led by shelter, food, and energy. The report caps off a year in which inflation gradually eased but remains uneven, and core inflation was slightly below expectations in the latest month. The Prime Minister is meeting with coastal First Nations in BC today to discuss major projects. The President of the Coastal First Nations says there is no support among the group for a pipeline through BC or the suspension of the oil tanker moratorium off the north coast of the province. This comes ahead of Carney's departure for China, where he aims to boost engagement on trade, energy, agriculture, and international security. McDonald's Canada is freezing the price of some items for a year. A small cup of coffee will be $1, and the price of McValue meals is dropping to $5. The fast food chain says Canadians are facing challenges and are insecure financially. It says this freeze is what customers are looking for. In recent months, Tim Hortons, Wendy's, and Burger King have all introduced meal deals or small combos. There's a look at the TSX in record territory, once again helped out, as I mentioned, by silver stocks. Let's have a look at oil. Now, we have seen some strength in oil with the price of crude topping $60, in fact, hitting 61 right now. And we saw the world price, the Brent contract, going to $65 amid concerns over geopolitical conflict. Let's have a look at gold, because it too has hit record highs once again. And let's have a look at the Canadian dollar versus its U.S. counterpart, and our currency holding its own at just over 72 cents U.S. TSX outpacing the US market once again this year. That's after outperformance in 2025. Can this run continue? We're joined by Mike Vinokur, portfolio manager and senior wealth advisor at Propellus Wealth Partners at IA Private Wealth. Mike, great to see you. Thanks for joining us.
Great to see you. Happy New Year.
Happy New Year. So, I mean, obviously any index, it's a little misleading because some groups are strong, others can be weak, but generally the Canadian market doing well again.
Absolutely. I mean, you've got, this sort of reminds us a little bit of the 2000 period. If you recall, we had this 2000 to 2006 period where commodities just took off.
As China went gangbusters.
Yes, and also you know, it was the time I remember distinctly when oil hit $10 and Warren Buffett was investing in energy and commodities and everybody called him a dinosaur because it was all about tech and not about the things that make the world go round. And it sort of reminds us of that era because everybody's been chasing tech and semiconductors and a whole bunch of other very exciting industries, absolutely. But the thing that makes the world go round is the basic inputs. And we feel that, you know, the world has not invested enough in those basic inputs. And you're seeing that come back into the fray now with all of these commodity prices going up. The market is telling you that we need more of this stuff and we need the producers to make those long-term investments.
Certainly, we keep hearing dire predictions when it comes to copper.
Dire to the
of
upside.
Shortage, yeah, exactly.
Absolutely. We wouldn't be surprised to see copper in the $8 range. I think that's 15,000 a ton. I think it's now 13 and change thousand a ton, and it's going higher because the electrification of the economy and the mass power demand is just going to require many more tons of it.
You do say, though, that some valuations in the TSX, certain sectors are getting a bit rich. What areas of the market?
So it's not that they're necessarily getting rich, but they are a little bit extended, overbought, let's just say. Nothing goes up like a hockey stick. We like to see a little bit of pullback and consolidation before you go higher. Having said that, if you look at the banking index, we're getting a little bit concerned that some of the multiples on the Canadian banks and some of the other financials are maybe getting ahead of themselves. If you look historically speaking, you know, banks have traded in the 10, 13, 14% forward, 14x multiple forward multiples. And, you know, we're sort of in that area. And we think that the market is pricing in this no recession, no slowdown, no credit risk era. And we just think that maybe there's a little bit more risk that needs to be priced in.
What about energy? How are you playing that these days?
So we're very excited about energy. We think that energy is sort of the one commodity that really hasn't gotten much love in the last little bit. We think that we are not decarbonizing, unfortunately, meaning that the world needs oil. And maybe the demand growth is no longer the heady 2-3 million barrels a day. Maybe it's closer to 1 million barrels a day. But the reality is that the energy industry has really not invested the vast amounts of capital needed in order to replenish reserves ready for production. And so we are focused on producers that we think are trading at extremely compelling levels, that can pay out dividends, not take on too much debt, return capital to shareholders, and even grow their production at these low prices. And wow, do they have torque if we're right and prices in, say, the next 12 to 24 months go up a lot from here.
And Cenovus is one stock that meets your expectations.
Absolutely. Cenovus is a very well-run company in our view. They've made some really great acquisitions. The last one that they won was Meg Energy, a very interesting acquisition for them because the land package is sort of contiguous to what they already own. We think they're going to have synergies in that acquisition. The management team is very shareholder focused, but also focused on leading the company in a growth trajectory. And it's sort of an integrated, like Suncor, in that they have some refinery capacity, and that sort of shields them by having the downstream business along with the upstream business.
And another stock, Hewlett-Packard Enterprise. What attracts you there?
So it's Hewlett-Packard, not Hewlett-Packard Enterprise.
Oh, I'm sorry.
Yeah.
Okay.
So this is the old personal computer, enterprise computer systems, printing, things of that nature, HPQ, before the split.
So this is HP Incorporated, I think.
Yeah,
HP, sorry. Okay,
HP Incorporated, yeah. So it's gotten no love. You could see by the stock price, it's down from the 30s last year, now at $20. Well, at $20, what is the market pricing in? Well, you've got a stock that's paying a 5.5 to 5.7% dividend. Mm-hmm. They're generating loads of free cash flow. We believe that there's a rejuvenation cycle happening in compute in general. You're seeing it in the semiconductor space. But what about the average worker who needs more, faster RAM, faster chips, more processing to become more efficient? Well, Hewlett-Packard is one of a handful of names that's sort of that in the business. And what we like about this business is their margins on the computer side are not that big. They're 5 or 6%. But imagine, Andy, if they're able to go from 5.5% to 6.5% by just doing some cost cutting or even importing AI into their business, that drops straight to the bottom line. And when you're looking at a stock that's trading at 7 times free cash flow or thereabouts, that's not asking a lot of the valuation in order to have a margin of safety to the upside, while we believe not much to the downside.
Thank you very much, Mike.
Pleasure to be here.
Mike Vinokur, portfolio manager and senior wealth advisor at Propellus Wealth Partners, IA Private Wealth. Up next, we're going to hear why at least one observer says Canadians invent technology, but then it leaves the country and we end up buying it back in the shape of products. We're going to talk about the lack of Canadian innovation when we come back. Canada wants to make its economy less reliant on the US. We have these persistent productivity challenges and low innovation. Our guest has been thinking deeply about this problem. We're joined by Richard Gold, director of the Centre for Intellectual Property Policy at McGill University. Thanks very much for joining us.
Thank you for having me.
It's a complex area. First off, one problem you identify is just a simple lack of investment in dollar terms in innovation and research.
That's right. So our government plays a bigger role in Canada than in other countries because the private sector hasn't been investing. And there are many different theories about why that is. Too much regulation. Some people say it's culture. But the bottom line is they're not investing enough. And then the Canadian government itself is not investing as much in university research, the provinces as well. So our universities are underfunded. And yet they're still producing a lot of knowledge. But that knowledge is not translating into innovations that stay in Canada.
Yeah, I mean, the numbers are amazing. Canada invests, about $11 billion federally and provincially in research, less than 2% of GDP. But the Americans invest federally 3.5% of GDP. So we're just nowhere in terms of dollar volume.
Right. And a lot of that in the U.S. is through things like defense.
Yeah.
So with our new policies, maybe we'll start investing more in research in order to find dual-use technologies that are both useful for defense, but also for other products and services.
Right. We'll be investing in more ways, researching more ways to kill people. But anyway, let's not go down that road. But you're also concerned that the money we do spend, we don't get a decent return on. Just talk about that briefly, if you would.
That's right. So because we have so little investment, there's really no ecosystem or a strong enough ecosystem to support those firms that are innovative. And so what happens is we get these great ideas out of our universities. We get some small firms that develop it. But there's nowhere for them to grow in Canada. They don't have access to capital. They don't have other suppliers and collaborators within Canada. So they end up selling their intellectual property, usually to firms in the United States. They develop it and then send it back. So for AI, for example, there was one study that showed well over 50% of Canadian developed AI patents actually get transferred outside the country.
Talk to us about patents and what we can do. I know this is a complex area, but what's the number one thing we need to do to get more intellectual property for Canada?
So to do that, we actually have to fund research. We have to get firms to invest in working with universities to take out that knowledge, transform it into intellectual property that stay in Canada. So we need our big Canadian firms, our banks, our mining companies, our oil and gas sector, health sector, et cetera, to invest in research and to the point where they can develop new products and services and then sell them to the world. So we need more Canadian firms based in Canada to acquire the knowledge and then turn them into patents and other intellectual property.
You may have seen the government has this list of favorite projects that it says are nation builders. I looked at it and I thought, copper mines? Ports, is that really the future of Canada? I would have liked to have seen much more investment in research and technology.
I agree with you, but even these sectors could benefit greatly from innovation. If you go into a mine, it looks much like it was 100 years ago. Imagine if those big mining companies or any of these companies started investing in cheaper ways to do things, using new materials, using AI to find new sources of oil and gas or of minerals, develop better materials for the pipelines. Then we have innovation. But just building a pipeline across the country using existing technology, sure, it creates jobs in the short term, but doesn't sustain us.
Now, there's a thing called patent pools. What the heck are they, and how could that improve the situation?
So a patent pool is basically a big fund that purchases patents that are critical to Canadian firms. We're not going to be good at everything. We never have been. Think about the Canada arm on the space shuttle or the space station. We were good at that. We were not good at the rest. So this fund would purchase patents and make them available to Canadian firms so that the Canadian firms aren't sued by Americans or Europeans. They develop the technology, they develop their own innovative products, and they sell that to the world. So it's really a way to allow Canadian firms to access key knowledge in those areas. You can't do everything, though, and these funds have a limit on them.
Applying for government support is notoriously bureaucratic and painful. And I've also heard it said that you're dealing with one official and next minute they've moved on and you got to kind of start from zero with another. So bureaucracy is a problem?
Bureaucracy is always a problem, but not having the government invest in innovation when we have such a poor ecosystem is a mistake. Relying on the market to fix our problems hasn't worked. The United States doesn't do it. They invest massively, as we talked about, in defense, but many other industries. So the government has to be a partner, but they can be bureaucratic. So my recommendation is, and I'm not the only one, set up an independent but government-funded entity that would manage this and hopefully decrease bureaucracy in doing so.
We have a banking industry that looks very like an oligopoly, according to the Deputy Governor of the Bank of Canada, or she's expressed concerns over lack of competition. Do we have complacent banks that are not backing research and innovation?
Well, I think we have large firms that are complacent. They're just not investing enough. They don't feel the pressure to actually invest in research and innovation. And that's across all sectors. It's in our cell phones, it's in banking, it's in all of these really critical sectors where we have large firms. So competition is clearly something that would assist everywhere, because then these large firms need to look to new ways to compete. And often that is through innovation.
Richard, thank you very much indeed.
Well, thank you for having me.
Richard Gold, Director of the Center for Intellectual Property Policy at McGill University. Okay, coming up, today's ETF report and a look at the record-setting year for the Canadian ETF industry last year and how many ETFs are becoming increasingly sophisticated. That's ahead. We know the Canadian ETF market had a massive year last year, record-setting growth. Let's get more from Valerie Grimba, Director of Global ETF Strategy at RBC Capital Markets. Valerie, thank you very much indeed for joining us. You have some interesting observations here. One is that we're into an era where so-called digital natives are investing. These are younger people, not all of them young, some in their 30s, who've essentially been on the internet their whole life. What effect is that having on the ETF market?
Absolutely. This segment has really been creating and shifting trends in the ETF market really since the pandemic, since 2020. But even more so in 2025. And what we're seeing is the rise of education, investment content coming to market through these digital channels. And then the ETF vehicle is there for this type of investor to pursue those investment strategies in different ways and using the ETF really to provide different types of access that they might not have had before or without an ETF to do that.
ETFs are getting more complex, and in some cases they're getting racier, aren't they? Using leverage to produce, in theory, big returns from day to day.
Yeah, exactly. And I think this gift, this choice, this extra choice for investors is a gift, but there is an amount of due diligence that needs to go alongside this increased sophistication. Listen, again, this is about the ETF as an access tool, as a vehicle to kind of democratize investment access. So we have strategies like CLOs, which before were the domain of institutional investors. We are going to see the continued rollout of structured products embedded within an ETF, and previously structured products were the domain of advisors. So again, it's about providing these different tactical tools and using really the ETF to give those tactical tools to investors that might not have had access to these investment strategies prior. So I think it's just a great thing, and it's really exciting time to see this innovation in the industry.
We learn something new every day. Apparently, there's a thing out there called auto-callables, and they've been wrapped into an ETF structure. What are auto-callables?
Andy, that's the million-dollar question, and we probably won't have enough time to get into it today. But the gist, we can get into the gist. It is a series of structured notes that have this auto-callable feature where they can get called. But at the end of the day, the auto-callable is a strategy that is designed to provide additional incremental yield to the investor. There is, obviously in finance, a risk-reward picture that goes along with setting up the mechanism that provides that additional payout to the end investor. But if it does sound intriguing and these products are really taking off in the US, I would suggest an investor to do some research, watch some videos. Again, there is a lot of content out there in the world right now, which is absolutely wonderful. But buying an auto-callable product does require some investment knowledge and understanding what you're buying there.
Of course, the idea originally with ETFs was they just hold an entire index. Canada invented them with the famous XIU that would just track the TSX blue chip stocks. But active management has become the flavor of the past few years.
Yes, and I think this just kind of shows the versatility of the ETF vehicle. Listen, the passive ETFs, the kind of S&P 500 ETFs, the TSX Composite, these are going to still be the biggest and kind of the bread and butter of portfolio building blocks. But active management within an ETF has really been the story of 2025, and I think these trends will continue into 2026 as well, and we will see continued growth in in the active side of the ETF world. And really what's driving this is a handful of things, but really we're seeing ETF issuers or even asset managers in general seeing ETFs as the preferred vehicle of choice for investors, and they want to provide that best-in-class active management where they're promising outperformance and alpha generation and giving that kind of to the masses in the shape of an ETF. And so just to give an idea of how much they're punching above their weight, active ETF assets are less than 10%, but they saw nearly a third of all ETF fund flows in 2025. So it's clear that this segment has a lot of momentum, and I think this will carry through till 2026 as well.
That's amazing. So only about 10% of the existing universe is active ETFs, but a third of the flows. Yeah, that really does speak volumes. We have this obsession with yield. We've seen obviously one very popular category, these covered calls. Do you think there's any risk, though, investors understand that they may be giving up something with these covered call ETFs that give them a big yield?
Yeah, absolutely. It's just about making sure the investor understands what they're buying. They're neither inherently good nor bad. It's just a series of trade-offs, like all things and most things in finance, and you need to understand what you're trading off. So if you like the idea of consistent yield, if 10% yield is kind of what you're chasing for this part of your portfolio, then absolutely a covered call solution can make a lot of sense. But if you are, at the end of the day, just want kind of to optimize capital gains, then you might underperform just investing strictly in the underlying on its own. So again, trade-offs and understanding those trade-offs. But here in Canada, we've seen these ETFs really take off, and especially the ones that add a little bit of leverage, a quarter turn of leverage, to kind of again enhance those returns.
What about the trading of ETFs? Are they always liquid, or do they? I mean, I know they're designed not to go to a big discount because people will use arbitrage to create or destroy them. But is the trading liquidity all it could be?
Yes. I mean, and that's our job of market makers, is to step in and provide two-sided markets. But we're calling this the complexity conundrum. So it's great, we talked about it earlier, to get these more complex strategies within an ETF wrapper, but there is usually kind of wider spreads and maybe potentially higher trading costs. And again, that's not necessarily a bad thing. It's just something to be aware of. But really, I don't think liquidity in the ETF world has been a problem, and ETFs have really stepped up. You know, even saw through April of last year and Liberation Day and tariffs that ETFs provided that liquidity. They became that release valve for the market. And so we've seen, you know, the market really price things effectively and have no problem to kind of providing that intraday liquidity that ETFs are known for.
Valerie, thank you very much indeed.
Thank you, Andy.
Valerie Grimba, Director of Global ETF Strategy at RBC. Coming up, we're going to update you on the headlines on markets, and we're going to focus on what the Prime Minister hopes to achieve during his visit to China. Shares in JP Morgan under pressure today. The giant U.S. bank met estimates on revenue in the fourth quarter. However, there was an unexpected drop in investment banking fees. The biggest U.S. bank generated over $2 billion U.S. from the business in the last 3 months of 2025, but that was down 5% year over year. And Delta shares down 2%. That's after the airline beat earnings expectations, but issued a full-year revenue forecast that fell short of expectations. And the company was hesitant to commit to posting record earnings amid rising geopolitical instability. A limited foreign travel to the U.S. from Canada and China was of particular concern. Delta recently made the decision to order 30 Boeing 787 Dreamliner jets in its first ever purchase of that model. Aya Gold and Silver has boosted its silver production by 2% in the fourth quarter. The miner hit record output in the period and posted a full year of strong output at its mine in Morocco. The Quebec-based company also increased its per-day ore production from the previous quarter by 14%. company says it has completed ramping up that Moroccan mine and it's now well positioned for 2026. TSX pushing further into record territory. You can see the S&P down. Obviously, sentiment hurt a little bit by that decline in JP Morgan. The Prime Minister, Mr. Carney, is headed to China today as Canada looks to expand its pool of international trading partners. CTV's Annie Bergeron-Oliver has more on what the Prime Minister is hoping to achieve during this visit.
Prime Minister Mark Carney is getting set to depart for a 9-day trip to China, Qatar, and Davos. In all three countries, the Prime Minister will be meeting with foreign leaders, business leaders, and CEO, with the focus of expanding bilateral relations, increasing trade, and increasing foreign investment in Canada. Now, the part of this trip that's getting the most focus is his 3 nights in China. This is Prime Minister Mark Carney's first trip to China as Prime Minister, and also the first trip by a Canadian Prime Minister since former Prime Minister Justin Trudeau was there in 2017 to try to establish a free trade agreement. That did not happen, and very shortly after, the CEO of Huawei, Meng Wanzhou, was detained in Canada at the request of the United States. That led to China retaliating by detaining 2 Canadians, Michael Kovrig and Michael Spavar, who were eventually released. Relations with China have been strained and extremely tense since then, back in 2018. Now, the Prime Minister's office says that Carney and Xi have both agreed it's time to revive that relationship, to try to improve bilateral relations. And that is what this visit to China is all about. It's about trying to bring stability back to this relationship, to try to bring it back to where it was before 2018. Now, speaking on background, officials do say they expect to see some progress on tariffs, but they don't expect to see tariffs removed entirely. Right now, China has a 100% tariff on canola oil and strong tariffs on other agricultural products that are really threatening the industry. So again, officials are saying they do expect to see some progress on those tariffs, but they don't expect to see them removed completely. Of course, anything can change. Now, while in China, the Prime Minister will meet with Xi Jinping. He'll meet with the Premier. He will also meet with business leaders and CEOs. Again, the main focus here is trade, trying to get rid of these tariffs, trying to improve the bilateral relationship. However, there will also be other topics brought up. For example, they say agriculture, energy, very important issues. We expect to see some type of conversation around autos and EVs. This is what experts say they expect to bring up as part of that tariff discussion, and as well just trade in general. Now, the Prime Minister's office and officials speaking on background have said that they do expect the Prime Minister to make it very clear to the Chinese government and to Xi Jinping that Canada wants to increase business and trade with China. However, there are certain guardrails that they want to put up in place. For example, they don't want to do business in artificial intelligence or critical minerals. Now, again, this is a 9-day trip. The first stop will be China, then he'll go to Qatar, and then to Davos in Switzerland for the World Economic Forum. Annie Bergeron-Oliver, CTV News, Ottawa.
And Bloomberg is reporting that out of Asia, Hong Kong and Singapore, that the Chinese do plan once again to bring up this idea of easing our big import restrictions on Chinese electric vehicles in return for them reducing the barriers on Canadian canola. Coming up, hot picks in software. Our guest says you should be looking at these names as revenues accelerate. Let's get to hot picks. Our guest has 3 software ideas for you. He is looking for an acceleration in revenues linked to artificial intelligence. Let's get more from Gil Doria, Head of Technology Research at D.A. Davidson. Gil, always great to talk to you. And just remind us, we have heard this worry AI will hollow out traditional software companies, and of course it's going to vary. But what is your thinking when you hear that thesis?
That it's not going to be any different than any other technology cycle we've seen, which is to say, good companies that execute well will not only survive the AI revolution, they'll thrive in it. But that's not the market narrative. Software stocks have done very poorly the last couple of years because there's this notion that you can magically replace all of software with AI, that you can snap your fingers, vibe code some software, and companies will have a brand new marketing software, content management software, or enterprise resource planning software. We don't think that's the case. We think AI will get integrated into enterprise software gradually over the next few years, but good software companies will continue to do well. And this is the year where we think investors will learn that AI is not going to run over their software stocks.
Start off, if you would, with Manhattan Associates. They're in supply chain software. What attracts you to this stock?
This is a company that has very strong domain expertise in supply chain. That's warehouses, logistics, retail. Their customers default to Manhattan Associates software in order to manage complicated supply chains. It's very recurring revenue. Manhattan Associates has an army of consultants that have this very unique expertise in helping those participants manage their supply chain. Their next competitor is much smaller than they are. So they've been doing well and they'll continue to do well. And this is actually a year where, after a little bit of an air gap, they're going to have an acceleration of revenue growth in their cloud business and in their services business. And yet they're trading at the lowest multiple they've traded in a long time.
You have another idea for us, Zeta Global, which is a marketing software company. Just tell us what kind of software they provide and why do you think the stock holds promise?
So they help marketing departments get customers, know how to reach out to those customers and engage with them. But they also have a business with advertising agencies, especially digital advertising agencies, where they help those agencies reach customers, find out what the segmentation is, and be able to address them. And that's a business that's growing even faster than before. So they can serve that whole marketing ecosystem. They've been doing it very well. They're gaining share from companies like Salesforce.com. And that's why they've been growing so much faster. And we expect them to do that this year, exceed expectations, and even do it at a higher than expected profitability rate.
It is interesting. I mean, just remind us, we got this move, like so many other companies, they want us to pay for streaming. Don't just want to sell us a product one-off. Is that the name of the game now in software? Software as a service, you pay a regular fee?
Yes, for all these companies that we're talking about today, it's mostly hosted SaaS revenue, meaning it's recurring revenue. You sign up with one of these companies and you pay the same every year, and then at the end of the contract, upon renewal, it actually goes up a lot. That's part of what makes software businesses great. It's recurring revenue, it scales, and it comes in at very high incremental margins. Their gross margins are typically in the 70s or 80s, with very little need to increase the fixed cost. That's what makes software companies great businesses. The market's just forgotten that over the last couple of years because of the AI craze.
That's interesting. Finally, Box. Remind us what they do and tell us why you like the look of this one, Gil.
Content management. So instead of we as consumers have our iCloud or Dropbox, companies use Box for their content management. And Box has done a really good job of adapting to the age of AI. Since they manage unstructured data, so not just numbers in columns and rows, but documents and other things that don't fit into a box neatly, they are really having a resurgence right now, and we have a chance to see them accelerate revenue this year. And then that's not reflected in the stock at all. It's trading in the low teens on their cash flow, in spite of the fact that they're already showing signs of acceleration into this year. And Aaron Levy, the CEO there, is a very important figure in the tech community. He's a real thought leader in where AI is headed. And we think Box is going to get more and more credit for having that leadership position.
That's interesting. And what will you said that catalyst will be accelerating revenue, Gil? Just tell us what your thinking is on that.
The point is that over the last couple of years, most software companies have seen decelerating revenue, not because AI has disrupted them, but because AI has distracted their customers. Their customers have spent so much money on internal efforts to figure out what to do with AI that they've neglected their software stack. This is the year where enterprise technology customers now have a good understanding of what AI can and can't do, so they can go back to managing their business, which is to say, buy more software. That's why we think after a couple of years of decelerating growth, this is the year where good companies, as like the ones we just talked about, will see accelerating growth this year.
Gil, always great talking to you, and thank you very much indeed.
Thank you.
Gil Luria, Head of Technology Research at D.A. Davidson. Coming up, we are going to check back in on J.P. Morgan. Investors not thrilled by results in the latest 3 months. U.S. earnings season kicked off this morning. We got results from J.P. Morgan. Investment banking results disappointed investors. We were joined by Stephen Bigger, Director of Financial Services Research at Argus Research.
The investment banking results were a bit weaker than expected. There's been this multi-quarter narrative about how constructive the capital markets environment has been. So this could have been some timing. You have to close deals in the quarter in order to book those revenues, and some of that could get extended into 2026. We're still looking for this extended upturn, and the constructive commentary they did mention on the conference call this morning. The backlog is growing. You think you've got lower interest rates, you've got improving CEO confidence and boardroom confidence. You've got this pent-up backlog after kind of a weak 3-year period. You've got more relaxed regulatory framework, and all that really bodes well for the both the IPO and the M&A activity for banks with large capital markets operations.
J.P. Morgan, though, rolling up its sleeves for a fight, it seems, over any attempt to cap interest rates on credit cards. The CFO saying we'd have to significantly change our card businesses and that everything is on the table in pushing back.
Well, it sure is. Yeah, I think we'll see a very strong response by the industry here, as well as the industry advocates in this space. It's very difficult to when you kind of mess with this with a bank's ability to price risk and only just kind of this one part of the equation, the interest rate, bad things tend to happen. Whether it's the removal of credit availability, which is very much a disservice to consumers. You put extra risk in the system from not being able to cover credit losses adequately. We saw this in the financial crisis, where in the case of home lending in that era, where you make loans too easy to get and fuel speculation. You get bubbles and then a collapse in the very asset you're trying to help. So it's important to be careful here, I think, and take some time. And I don't think that is kind of inherent in the president's 10-day implementation period here. It's guardrails are very important, but it can be, over-regulation can be just as detrimental as under-regulation or poor regulation.
It's interesting, the stock up more than 30% in the past year. According to Bloomberg, though, there are 19 buys among analysts, but 12 holds and 3 sells. So it sounds like Wall Street not convinced that there's going to be big gains in the near term anyway for the shares.
Well, as much as the narrative on profit growth, I think, is intact. If you ask, all or most of those analysts, they would say, look, it's going to likely be a good year for profits for J.P. Morgan. So the question is about valuation. Has that 30% gain we've seen is that kind of take into account the expectation of continued improvement in 2026. And I would say, this is kind of a unique time for banks, particularly the large and the global banks, where this a bit of a re-rating is going on. Not only do they have this long runway, we think, of improvement in capital markets, and that is a big wild card in terms of revenues and profits for banks. So that extended upturn could lead to valuation improvement. We also have this kind of generational change in regulatory, right? Ever since the financial crisis, it's been nothing but more and greater regulation, more compliance costs, and all this to satisfy regulators. And we think we're in a period now where that is at a minimum going to stay steady and maybe even more likely soften a bit in terms of capital requirements. So that helps free up capital for lending and other uses, for buybacks, for dividends, and so forth. So I think we're going to have, if you think about the banking industry and kind of how it's evolved, and these stocks are not terribly expensive either, kind of 13 to 15 times are the 26 consensus estimates. So I think there is some more room. I don't expect 30% gains out of these large bank stocks, but and they have outperformed the market the last 2 years running. So this will be a third year. That's a little difficult. But again, I think the momentum is behind the profit story, and the re-rating does help those multiples.
I suppose one thing that could inflate their earnings would be a whole pile of initial public offerings and takeovers in the tech space fueled by AI.
Well, definitely. Certainly, if you think about M&A and global announced M&A deal value is up 40% in 2025. So again, a lot of pent-up demand there. It's this boardroom confidence, the competitive pressures to cut costs, the more favorable regulatory environment I mentioned. All of that can add to deal demand. And there's been a lot of these mega deals, especially, definitely in vogue now with. You think about scale across technology or the financial sector, industrials. Falling interest rates obviously is helping on the financing front. We've got banks that are willing and able to lend. We've got a market that's willing and able to accept new equity, new debt issuance. We had $95 billion of investment grade debt issuance in the first week of January. So that's the highest level since the pandemic. Credit spreads are around 15-year lows. So that's very good for debt issuance, and so the market is, I think, is waiting for that, and is helpful in terms of getting financing, making financing available. So all of that is really helping the M&A environment.
Let's have another look at JP Morgan stock. The New York Times has an interesting note here. On the conference call, Jamie Dimon, the CEO, usually very forthcoming, he was asked about this criminal investigation of Powell at the Fed. He first said, everyone believes in Fed independence. Anything that chips away at that is probably not a great idea. However, then another reporter asked a follow-up question, and the CFO, Jeremy Barnum, jumped in with, we've said enough. Clearly, well, it looks like concerned about antagonizing President Trump. We've said enough. We don't want to say too much about that. We've got results coming tomorrow from more big U.S. banks, Bank of America, Wells Fargo, and Citigroup. Thank you very much for watching The Open. Morning Markets is up next.